I am about to show you the most dangerous trade in the world right now. And despite the fact that countless individuals and even hedge funds have blown up using this exact same strategy, where they lose more in one day than they ever made in total combined in their history, more and more people are getting sucked into this trade right now. This is a sucker's bet, and it is called shorting volatility. I'm going to show you exactly how this trade works, why it's destined to destroy anybody who comes near it, and what you should be doing instead. So first, what is volatility? The simplest way to understand volatility is just if something starts moving up and or down more than it usually does. Volatility is typically used as a proxy for risk with certain investments, where investment advisors will say, hey, if that asset, that stock is more volatile than a different one, then it's going to be more risky for you. That's a terrible way to assess risk, by the way, but that's a story for another time. But volatility in the markets is calculated a different way. The most common way to assess volatility is by looking at the volatility index, which shows the volatility of the S&P 500. This is also commonly called the VIX. The way this index is calculated is by looking at the pricing of at-the-money options on the underlying index, which in this case is the S&P 500. When at-the-money calls and puts are higher priced than they used to be, then the market is pricing in a higher chance of volatility, because buyers of those options are willing to pay more for the likelihood or for the chance that the index will move one way or the other. And so the pricing of these at-the-money options is reflected in the value of the index. When the VIX is higher than normal, that reflects the index having higher than normal volatility. Similarly, when the index is lower than normal, as it is right now, the market is pricing in very, very, very little volatility. And right now we are seeing a huge increase in the amount of shorting this volatility. So you may be wondering, how in the world does somebody actually short a measure of how volatile something is? Well, the first way is to actually trade options on the volatility index itself. Because yes, there are derivatives for the VIX, which itself is priced through derivatives on its underlying index, in this case, the S&P 500. Essentially what that means is that traders and investors can place bets on whether the S&P 500 will become more or less volatile by buying or selling calls and puts on the VIX. But for most small and retail investors, that gets a little bit too complicated. And so they use something like this ETF, SVXY, instead. SVXY uses futures, which are similar to options, in order to track the inverse of the VIX. And given that after a spike in volatility, the VIX usually goes straight back down to an area of less volatility, investors will put their money into SVXY, especially after a dip. And as volatility bleeds out from the market, SVXY will shoot up higher. And as you can see, it's done extremely well. With over the past 2.5 years, SVXY has tripled. Now I'm going to explain exactly why volatility is so historically low right now compared to normal, why it's about to spike at some point soon here and destroy a lot of investors who are betting on it not spiking, and exactly what you can do instead, which is not only just playing the opposite side of this in a safe way, but also staying completely entirely away from it and still protecting your portfolio from it. And once we're all done with that, if you want more of how strategies like this can fit into your overall portfolio that protects you from blow up risk, teaches you how to make consistent profits, hedge your portfolio from large drawdowns, and expose yourself to asymmetric upside opportunities, it's time to become a member of Heresy Financial University. It's $99 a month, and the price for new members is going to be going up starting in 2024. But if you join now, become a member, your pricing is locked in, your grandfathered in forever. So as you can see, after volatility spikes, it normally bleeds back out and goes back down to more normal lower levels. This is because the volatility index is a measurement based on the prices of at-the-money options on the S&P 500. So when the S&P 500 is dropping, correcting, and crashing, the market starts to price in a higher and higher likelihood that that will continue. People pay more and more for that downside protection. But markets bottom once everybody has sold. This is why most people sell at the bottom, because the bottom happens when most people are selling. Similarly, the rally ends once everybody has bought, because there's nobody left to buy. This is also why most people buy at the top, because the top happens when most people are buying. Given that fact, when markets are at their bottom, they are bottoming when most people are selling and anticipating the market to continue to move further down. Therefore, the pricing and the market expectation will be highest for that volatility at that point. But because that's the bottom, volatility has nowhere to go but down as the market recovers, because the only thing left for anybody to do is to buy, because all the sellers have already sold. And so at those points of highest volatility, the sellers have sold, the market recovers, and volatility declines once again. And not only is the market at a high right now, volatility is at a low, but most people right now are betting on this continuing. If we take a look at volatility on just the mega cap tech stocks, as this chart from Bar Chart shows, volatility is at the lowest level it's been in 4 years. We can also see that from multiple measures, the demand for hedging has tumbled right now. The cost for hedging, which is a proxy for market expectations that the market will go down, is at its lowest ever level since 2013. Right now, there is no demand for hedging, according to the head of derivatives strategy at RBC Capital Markets. And the funny thing about this is that it's a little bit of a self-fulfilling prophecy, because the expectations that volatility will stay subdued invokes trading behavior that actually keeps volatility suppressed. Again, Amy Silverman says, volatility continues to be suppressed in our market right now due to volatility selling strategies. Because essentially, when you short something, you are selling it. And so the more people who are betting on volatility to decrease, the more sellers there are of volatility. That money flow itself will suppress the volatility levels. The problem is this can't actually continue forever. At some point, the trades start to get unwound. And usually the trades start to get unwound once the trade stops working quite as well. Up to this point, I've been showing you only the last couple of years on the VIX chart, but now we're going to zoom out and I'm going to show you what this chart looks like on the long-term basis. You can see every once in a while, there are these massive spikes in the VIX that only last 1 or a couple of days, but are monstrous spikes compared to where VIX normally sits. But first, a word from today's sponsor, iTrustCapital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where iTrustCapital comes in. iTrustCapital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, iTrustCapital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. This is because when the short volatility trade starts to unwind, all of those trades have to be closed out. And to close out a short, you have to buy, which means that all of those short volatility traders suddenly start adding to the pressure that increases volatility. And as you know, these things are usually like dominoes falling over. And so as volatility starts to increase from all the trading closing out their short volatility trades, that causes more and more losses for everybody else who is still short volatility, and they eventually have to close out as well. And you get this massive, swift, violent unwind of the short volatility trade. And just in case you're wondering how moves like this in in the VIX translate into other vehicles that we looked at earlier in the video, like SVXY, it's not pretty. This massive collapse in SVXY that happened in February of 2018 is this spike right here on the VIX. And when something goes from a split adjusted price of $556 per share down to $40 per share, more than a 90% drawdown, there is nothing that will ever happen that will ever get you back to break even. Because if we zoom in, even after that drop, and we take a look at the performance of XVXY was still pretty good, going from a low of $40 per share up to a high of about $70 per share. But obviously that is nowhere near what was needed to get it back to where it was before. And obviously it does no good when you experience another spike in volatility shortly after, and it hits a new low. This is the nature of a short volatility trade. You are playing with a time bomb. Short volatility strategies have fantastic returns for a long period of time, and then all at once, you blow up. Now you might think, well, that is true, but I just won't be in the trade that long. I'm going to be in it for a short amount of time and take advantage of these great returns while they last. And I'll be the first one to get out when volatility starts to spike. The problem is you may have already missed the boat on that one, because number one, you never know how long these things are gonna last. But number two, if history is any guide, according to Crescat Capital, we can see that usually tightening monetary policy leads to higher volatility periods of time. The white line on this chart is the VIX, and the red line on this chart is the federal funds rate moved forward 2 years. And with this 2-year lag accounted for, we can see that tight monetary policy usually leads to much higher periods of volatility, while lower rates that are easier monetary policy environments lead to lower volatility. This intuitively makes a ton of sense, because when there's a bunch of extra free money floating around, you're going to have more of that money flowing into assets like equities, decreasing volatility. And then when things get tight and debt starts to get defaulted on or deleveraging starts to happen, you're going to see blowups and you're going to see volatility increase. And given the fact that going back decades, the volatility index is rarely continuously at the levels of suppressed volatility like it is right now, it's just a matter of when, not a matter of if, we're going to see another spike in volatility. Now, I need to also warn you of a few other strategies that most small money retail investors use that will also blow up in your face. One of these is UVXY or similar ETFs, which is the opposite. UVXY is designed to be a leveraged tracker of the VIX. So when the VIX spikes, so does UVXY. As we're looking at the last couple of months of the VIX, we can see that the spike that happened in September and October of 2023 also resulted in an increase of the price of UVXY from about $13 a share to about $20 per share. Now let's zoom out. This is going to look like the scariest chart you've ever seen, as they continually have to do reverse stock splits in order to make sure that there's shares trading at the correct price. But you can see this gets out of hand pretty quickly, and the movement from the last couple of months looks like nothing ever happened compared to some of the movement from before. But even this massive spike that happened at the biggest spike of the VIX in 2020 is nothing compared to the long-term drawdowns of UVXY from just a few years earlier, making that historically large spike in the VIX again look like nothing. And zooming out all the way, we can see UVXY on a split adjusted basis has a high of $2.3 billion per share. So SVXY has blow up risk. You buy that, bet on it going up from volatility usually going down, and one day you'll wake up and it'll basically have lost you more than you've ever made on it. But UVXY will be death by 1,000 cuts. Any fund like this, and there are plenty of them, usually a lot of the other ones are just leveraged funds. They track an index, but they're levered. These have something called beta slippage. And it basically just means when you're tracking an underlying index using leverage, over time, your value will bleed out. This is because losses are always more powerful than gains. If you have a 50% loss, it will take you a 100% gain just to get back up to break even. If you have both a 50% gain and a 50% loss, regardless of the order in which that happens, you wind up with a 25% loss. And so funds like UVXY that track with leverage and underlying index will have this beta slippage to a high degree, meaning every time the underlying index moves, these funds move as well to a greater degree, and those larger losses just pile up over time, and you're never able to have large enough wins in order to compensate for all of those large losses. So UVXY and other funds like this are a sucker's bet as well. Now, there are other funds out there that attempt to compensate for both sides, play both sides of this so that you can play VIX on the way down and benefit from when it blows up. One of these funds is SVOL, the Simplified Volatility Premium ETF. This fund tries to take the best of both worlds by going up just like SVXY does when the VIX goes down. It does this by primarily shorting volatility, but it also has a small position built like UVXY does, which is basically just using out of the money calls on the VIX so that if we ever get a big spike in the VIX, then the payoff from those long shot bets will be more than the losses on the rest of its portfolio. But because this is a strategy that has to be continuously implemented, the costs will never be outweighed by the gains. And this is why, despite the fact that this fund is supposed to profit from volatility bleeding out, that since this fund's inception in May of 2021, when SVXY has done phenomenally, a fund like SVOL just simply can't keep up. And in the event that volatility does spike enough for SVOL to have profits on those long shot bets, 99 times out of 100, it's never going to be enough to make up for the losses SVOL has incurred from its costs along the way. If none of that made sense to you, don't worry at all. The short story of this is do not use ETFs like this that have any volatility strategies whatsoever. Don't touch them with a 10-foot pole. None of them are worth it. Instead, here are 3 very simple things that you can do yourself if you want to protect yourself or even take advantage of volatility. Number 1, go direct. Do it yourself. When volatility is historically suppressed, buy out of the money calls on the VIX. When volatility is historically high and when it spikes, buy puts on the VIX. By buying these options, you limit your risk. Instead of selling options where you're taking on more potential risk than you stand to gain, buying options, you limit your risk and you can only lose what you spent. The second advantage to doing it this way is that you can time things. Unlike these funds that have to continually be using their money for the exact same strategy, you can time this. You don't have to do it every day. Unless volatility is historically low like it is right now, or historically high like it's been in the past, you don't need to engage in any volatility trades whatsoever. You take advantage of the opportunities when they come. You don't try and force the opportunities to happen. Now, full disclosure, with strategies like this, 9 times out of 10, you will lose. That's the nature with these strategies. They are a low probability that they will work out, but in the event that they do, they'll make you way more than you ever lost on implementing that trade in the past. So you'll lose often and little bits at a time, and you'll win rarely, but huge. And then finally, given the fact that the VIX usually spikes when the market sells off, as you can see during one of the biggest market crashes in recent history in 2020 was the biggest spike in the VIX, you can simply hedge your equities and call it a day. That way, when this short volatility trade blows up and unwinds, we get a big spike in volatility and the associated correction or quick crash in the market, you're not negatively impacted sitting on losses and waiting for it to come back to even. And then finally, if you want to learn how to do this safely and you don't know how, become a member of Heresy Financial University. Do it before the end of the year when the price is going to go up. Get yourself grandfathered in. Link is in the description below. As always, thanks so much for watching. Have a great day.